Hi, I'm Peter Rose, founder of Longwood Currency Trading, Forex day trading, risk management. And it is day trading. I'm a day trader. And if you go to my website at longwoodcurrencytrading.com, on the currency trading page, there are 7 reasons I list why, first of all, Forex is my selection. Currency trading is my selection. That's after a 40-year career as a real estate investor that I would choose to move to Forex. And I've had experience in stock options. I've had experience in stocks. I studied commodities for a while, traded stock options for 4 years. So I kind of have a broad, diverse background in the financial markets, stretching back to, the about the mid-1970s, I guess, when I first started getting involved in this stuff. So I have that diverse look at all the markets that are out there, financial markets. And so first of all, you have to say, well, why do you trade currencies? And then the second question comes up, are you going to be a scalper, a day trader, a swing trader, or a position trader? I think that the scalping is a whole totally different animal than if you're going to select between day trading, swing, or position trading. I think we can take swing trading out as a viable alternative simply because it's like, the term is catching a falling knife. When you're swing trading, you're looking for that swing, and if it goes against you, it's like catching that falling knife. It's trying to get in at the right time or get out after it's proven itself that it's wrong, and it's a very tough call to make. It's very difficult to call swing trading. You have to be really experienced in order to do that, particularly in the currency markets, because the order flow is based on different things than you might find in GM stock or something like that. So of the stuff that you have available in currency trading, it's going to be day trading, or it's going to be long-term position trading with scalping as a side activity. That if you can learn day trading, then you can do scalping. But if you learn scalping, you're probably going to lose all your money right off the bat, because the first thing you have to learn, whether you're doing scalping or day trading or long-term position trading, you have to understand trading itself. And then you understand the vehicle that you're applying the trading principles that you've learned against that market, that particular market. In the currency market, which all I talk about because I'm out of real estate, all I do is trade currencies. And in specifically to the day trading of those currency markets, why day trading over the long-term position trading, and why? How do you do that? The why is very simple, because I feel that I have more risk management control over my trading, being a day trader and flat at the end of the day, than I do on a long-term position trade. The primary reason that I'm a day trader is I have a very strong technical background. I have a degree in physics, almost a minor in math. I was a software engineer for 33 years. I was a real estate investor for 40. So I understand stuff that you might not have the opportunity to do that. And so I've looked at the currency markets, and the determination is that the day trader who goes flat at the end of the day is far safer than the long-term position trader who's going to be making certain decisions based on long time in the future, as opposed to all I got to know what's going to happen in the next 15 minutes. And I think I have a higher probability of determining what's going to happen in the next 15 minutes, or maybe even as much as the next 2 hours, than I do in what's going to happen in the next 2 weeks or whatever when you're a position trader. Sure, a position trade, you could do that for a few days. I think you'll find that the pullbacks on a few day move as far as a position trader is a lot like a scalping. You're scalping long-term positions. I just think the mathematics is going to give you a hard time. I've run the math on that. I understand what I'm talking about. You should run the math, and you'll see what I mean. If you don't know how to run the math on that, well, then you need some education from somebody who has done that, and they can explain it to you. In the day trading environment, the number one key is that you're flat at the end of the day. You don't have to worry about anything. If you're in there trading currencies on a large position size, and I'm not talking about you guys who are trading a single full lot or whatever, because you're not going to be trading a single full lot for your whole life. How much can you make at 10 bucks a pip? How's that going to change your life? It isn't. I mean, you might be able to pay your light bill on a $10,000 account. You're trading one full lot, make a couple of $1,000 a year, 20% return. You'd be able to do that. That's fine. But you're not going to replace your job income unless you're trading on a $10,000 account, unless you're jacking it up and trading it at 200 to 1 or 500 to 1. Then you're just throwing dice. You're gambling. That's not trading. Just because there's a lot of people out there trading at 200 to 1 doesn't mean that you can do it. Trading high leverage is not done on the opening. It's done differently, and if you don't understand that, and you don't know how to manage your risk, which is totally different than just trading would indicate, for the mathematics of trading would indicate, you're just asking for trouble. So leverage is not a component in anything I talk about, because that's not good risk management, regardless of whether you're scalping or day trading or swing or long-term position. The long-term leverage is out. If you get really lucky 6 times in a row, you can run a $20,000 account to high 6 figures. That's no problem. However, on that 7th run or 8th run or whatever it is, you'll lose the 6 figures. I mean, that's just what happens. It's called, in mathematics, we call that risk of ruin. You might want to look that concept up if you're going to trade currencies. I cover it in my coursework with folks as part of the risk management principles that we're trying to work through and develop rules from. But suffice it to say that trading with leverage over, well, I trade at 10 to 1 leverage. And there's reasons for that. I'm not going to get into it now because it's not about leverage. It's about the day trading process itself. How do you do that? But first we have to say why. First of all, it's safer because at the end of the day, you're flat. If some catastrophe happens, let's say you've got a runner, you've got a 20 pip profit target that you hit, and it looks like it's still got some juice to go, so you run a 10 pip or 20 pip stop behind the current price, and you go to bed, and you wake up in the morning, and some fool dumped a whole bunch of his positions, and you reacted against that 20 pip stop, and now you're negative on your position because of the running stop that you put behind it. How many times does that happen? Well, look at the chart. Look at the I don't know, probably the hourly chart would be a good indicator when you go past your Betty time. What are the pullbacks? What are the retracements? You know, if you go into the long-term, the major pairs, and you look at like a 15-minute chart, you see the price go from normal type behavior to this kind of thing. We call it a damped harmonic oscillator motion. I mean, that's mathematics. There's reasons why the patterns turn from just range bound or trending markets into this damped harmonic oscillator decaying pattern, going from maybe ATR on a daily chart, a 5-minute chart, ATR 5 pips to maybe a quarter pip or 1 pip on a 5-minute ATR, because both pair of countries are asleep. Or they're not trading, or one of the pairs is asleep and the other one is still going on another time zone. You get those types of motions. But when you come out of that, on the other side, look at your charts and see what happens to that price. That price could go 20 or 30 pips And it usually will do it in the opposite direction, because people who got in thinking that price was going to do something and it didn't, they're out of the position. Or maybe there was I don't know, some kind of a major issue that happened in the country, and there's an announcement while you're sleeping. You wake up in the morning and your stop got hit, and again you go underwater on that. Why go to sleep and disrupt your sleep worrying about what that position is going to do, whether you're going to wake up in the morning and you're going to have a 40 or 50 pip gain on that thing, or whether you're stopped and get a 10 pip gain? Why not go out at the end of the day? If the thing isn't doing what you thought it was going to do and moving toward your profit target in the 2 hours or whatever time frame it is that you're looking at your position, what makes you think that it's going to continue in the correct direction while you sleep? There's a risk management logic conundrum there that a lot of folks fall into because they're trading on hope. Oh, I've got so much invested in this trade because I think it should do blah, 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 blah because of blah, 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 blah. But it doesn't do that. So they go, well, I'll carry it overnight, and maybe what? You take all of that risk management and all of that uncertainty out of your life simply by going flat at the end of the day, regardless of what your position is doing. Unless you have a real screamer going on and that price is gone. And again, on a day trade, when I am doing my own positioning work, that profit target has to be 20 to 30 pips away, and I'm looking to get 15 of those. Maybe I'll get to the 20. Yesterday I was trading. I was looking at an initial profit target of just 5 pips. I was just looking for a quick hit. It seemed like it was moving. I dropped my limit order to get out and carried it through, and I got 15 pips on the trade, and it got 15 pips and then swung back around against me. If I wouldn't have got out at that 15, the trade would have been a loser because it retracted back in a 1 minute bar that went 25 pips, I think. And I was only 15 pips in profit, so I'd have gone at 5 pip negative if I would have held on to that position. And that got out at the when I just saw that when I just took the trade. If I wouldn't have got out at that point and waited for a longer period of time, then the position that I had would have gone negative on me. Risk management has to deal with making the decisions to exit the position. That's a complex problem to solve. I've simplified things by what I call the life cycle of a currency position, which is a rip on the software development life cycle. That I was a software engineer for 33 years and applied the software development life cycle to solving complex business applications, the programmatic solutions, to very complex business solutions. And it simply says you take a big complex problem and break it down into a bunch of simple problems, and then you ladder through a series of steps through each one of those problems. You go to the next problem, and you ladder through and solve that problem. You iterate back to the first one, make sure that the communication between those first two problems is legit, and then you bind them together through communication, and then you go on and solve the next problem. So that solution process is incorporated in my life cycle of a currency position, which is entry analysis, position management, and exit methodology. Those are the 3 problems that you need to solve when you're solving a currency position. How do I get in? What's the analysis I do, and how do I get in? How do I manage that position once I'm in there? And how do I get out? You say, oh, you get out, you just hit bid ask out. You know, whatever it is you got to do. No, that isn't it. Are you getting out because of a percentage gain against a trade? Are you getting out because of a profit target that's hit? Are you getting out because it's gone a percentage further beyond your profit target, but it's running into structural congestion, so you need to get out there? Are you getting out because of chatter? Are you getting out because of a staggering price on a runner? Are you getting out because of some the pending news release against a economic indicator, not the news. You can't trade against the news because those are lagging indicators. But like an NFP or a CPI release, you want to get out of the market. You don't want to sit there during one of those because you'll get chopped. So exiting the position is not as simple as just hitting the button. I see so many people on YouTube out there, so I just got out. Oh, you just got out. Well, either you're stupid or you're a good trader and you don't understand how complex that situation is, or you're not a really good educator and you see stuff that you don't know how to communicate to somebody, so you say, well, I got out because it hit the fib number or some stupid shit like that. Those are three problems: entry analysis, position management, and exit methodology. And as a day trader, I encompass all three of those problems, the solution of all three problems, in a 2-hour time frame, because that's all I want to sit at the computer. I don't know about you. Are you working a job? You're going to be able to trade all day long? Well, probably not. Do you even have 2 hours a day that you can trade? What do you think? You're going to come in at the end of the day at 7 o'clock at night and you're going to trade? And you might be able to trade the Asian session at midnight and on, but how early do you have to get up and go to work? So don't you think you've got to get to bed at some point? Where are you going to trade? So depending on the pair that you pick and your job, I'm sure that you can carve out a couple of hours, which is ideal. If you get your entry analysis done, you can do all that in 15 seconds. That's what I do. I get the entry analysis done quickly so that I know I can estimate, well, this isn't happening right now. I'll set a limit order so it'll pop when price gets to that limit order. That should take about this much time based on the current volatility that I see and the economic environment that currently is the sauce that's driving all this stuff. So I know when the thing should get hit. And because part of my entry analysis rules has to do with volatility and price action, we're able to judge basically whether we're in an increasing volatility environment or decreasing one. So that tells me the probability of how far that price should go and what time frame. I'm not looking for a 5-minute chart, 5 ATR position to move 20 lots in 20 pips in 10 minutes. I mean, I'd already be in a blow-off, and I'd already be in the trade if that was going on. So I'm looking at that entry saying, within a 2-hour window, it should be able to get to 20 or 30 pips. So that within an hour or 45 minutes or an hour and a quarter, that price should get to some point perhaps before the profit target is hit, because the profit target is just a suggestion. I can't count on that. It's a probabilistic thing that sits in the cloud somewhere. The only thing I have control over, in whether I'm day trading or position trading, the only thing I have control over is my risk. So my risk is established. I know exactly what my risk is. And if price moves in my favor, I bring the risk up to break even. If it goes slightly against me, I'm out. Well, why not get out with no gain as opposed to losing 20 pips on a stop that could keep on going to 40 or 50 pips? Why not just get out when it's bad? How do I determine that I should get out on a short 5-pip retracement as opposed to letting it go 20 pips? That's part of the educational process that you guys aren't getting from the courses that you're taking. This is really critical stuff. If you're not solving those three problems and you know how to go through and set conditions for each one of those rules, things aren't going to fit together for you. And so day trading isn't going to make any sense for you. That's why the long-term position traders, I don't know where they got their idea that trading currencies was a good idea in a long position, other than maybe they're thinking about the bank traders. They have bank traders, all they do is buy currencies. That's all they do it. So they warehouse these currencies for months until all of a sudden there's this panic that goes on and everybody needs that currency. Guess who's got it to sell? You don't have that capability. You're not long-term position. You can't hold through the gyrations. When you're evaluating this day trade, you put a cap on it of the day. You put a secondary cap on it for the 2 hours that you're going to be able to be there. Or, again, if it's a runner, you may want to put a running stop behind that, trailing stop. And then when you get home from work at the end of the day, you could check your thing. If the stop hasn't triggered off and the price is still moving in your favor, you got another couple hours that you could sit there. You spend a couple hours in the morning, spend a couple hours in the evening managing that trade and seeing how far it's going to go. But I would not go to Betty Buy with a runner. Because you just don't know what's going to happen. Unless your runner is way out there, 50, 60, 70 pips. Then you can put a 10 or a 15 or a 20 pip trailing stop behind it, and if you lose 20 pips on the trail, that's okay because you've made 50, 60, 70, 80, 100 pips or whatever it is that's gone behind it. You don't mind losing the 20 because you've more than made up for that risk. But that's how you play a runner. And runner rules are different than entry analysis, position management, and exit methodology. Runners are not part of position management. There's a whole different rule set that has to go with that because it's a different problem to solve. Man, oh man, oh man. If you don't understand this, that's probably why you think that currency trading is difficult. It's not difficult. It's simple. It's not easy to implement because you've got your brain working against you. But the rules are simple. The trading is very simple. Now, like I said, I've got entry analysis that I do in 15 seconds. I turn on the computer in the morning, I go in, I brush my teeth. When the computer comes back up, I load the trading platform and I take a look at it. Oh, okay. There's something that needs to be done right now. Good. I sit down and hit bid ask. Oh, there's something that could be done, but I got to watch and see what happens in 10 or 15 minutes. I'll go off and get a cup of coffee. Or, now this isn't gonna do anything. I don't have to worry about this. I probably won't even trade today. Go off and do something else. If I wander back and the things change, I evaluate the situation again. Oh, there's something going on here. This looks like it could go. Okay, I'll put a limit order in. We'll see what happens. You have to understand how these rules can be time-based, tweaked, in order to fit your availability, I guess, is a good term for it, in your time that you're going to be able to sit at the trading desk and trade. So, in an ideal situation, what I try to do, because I don't want to trade at night. I want to watch a movie with my wife at night, or have dinner with a glass of wine. I don't have my trading platform beeping at me. I don't want to do that. So, I'm retired now, so I can trade all day long. I mean, the trading platform's open all day, and so if I want to pop a trade at 3 o'clock in the afternoon, I can do that. But I try to, when I get up, and I'm usually at the trading desk by 8 o'clock, because a lot of the time the market indicators, the NFPs and the CPIs, retail trading index, housing starts, all those economic indicator number value releases come out around 8:30 in the morning. Some of them are out at 2 o'clock in the afternoon, but the majority of them are, this is U.S. Eastern time, my time, so I get up about 8 o'clock. And so I'm there. When I was working, I'd have to get up at 6 o'clock in the morning. And because I had to be out the door at 7 or probably about 7 or 7:15 to get to my job. I had an hour commute. Most of the times I had over an hour commute. So if I was going to trade for a couple hours in the morning, I'd be up at 5 o'clock. I'd trade to 7 and I'd hit the door. It was pretty simple. Now, I don't want to be driving down the highway wondering what was going on with my trade. So the rules that I developed were based on day trading, subset 2-hour time frame, with a corollary when the two currencies in the pair are actively trading during my time frame that I'm involved in. I mean, I've got students and people that I talk with and whatever, they're in another country, maybe you're in Pakistan or France or something like that. Your timings are totally different. But the rules that I work with and these timings and how you put things together are agnostic to exactly where you are. They are structured so that it fits no matter what time you are. You can work you can work this process out because it's based on price action, not based on what fucking time of day it is. drinking out of a paper cup today because I was just out visiting one of my long-term karate disciples. He's been with me. He's a master in his own right. He'd been with me, I don't know, 40 years, 45 years. He and his wife are just up from Florida, so I met them at one of the local coffee shops. They were up visiting, and we had a nice chat, and I grabbed a coffee on the way back, and here I am. So that's my coffee story for the day. As far as day trading goes, I think I've shown you the need for this underlying preparation work that provides the how you execute. I've given you the what you need to do. Now, if you need to know how to do that, and particularly when to do it, well, you're going to have a course, you're going to have to do some consulting or do some study on your own. You're not stupid, you can figure it out on your own. But if you listen to some of these other people that are out there, it's disaster because they don't know how to teach, they don't know how to organize things. I'm an expert educator. I've taught martial arts for over 50 years. That's a pretty complicated thing, to be able to teach people skills that enable them to defend themselves in the street and also to walk through life with confidence so they're not unafraid of anything going on in their lives, and they can therefore live a relaxed and happy life, let alone having to smack somebody in the face, some dumbass. Your currency trading should be the same. It should be relaxing for you. It should be fun. So all you got to do is figure out what the problem is you're trying to solve, break it up into simpler chunks, solve each one of those chunks, and make sure they're sequential and not independent. So instead of 3 solutions that you have in sequential order, you end up with 21 different permutations of 3 different things in different orders. You don't want to get involved in that. You've heard me discuss those in my videos. So I hope I've explained the what to you, and that you're capable then of carrying that forth and working through the how and the when. If you need help with that, send me an email. I'd be happy to communicate with you. If you get with somebody who knows what they're doing, you'll be surprised how simple it all goes together. It doesn't take me long in working with somebody and they go, really? Is that simple? I go, yeah, it really is. Now you just have to believe that and then follow this bouncing ball as we go through the solution process, and you'll have it all in a few weeks. This is all it takes. It's all-encompassing, full-on work that you need to do, but let's get it done in 30 days. What are you going to do? You're going to muck around for 2 or 3? I talk to people that go, oh, I've been trading for 3 years and I'm not consistent, I'm not profitable. 3 years? Oh, man, if it takes you more than a couple of months, you've got some experience. If it takes you more than a month or 2 to get on track, then you're doing something wrong, or the education that you're getting is wrong. If you don't have any experience and you're a relative beginner, we've got to go back and we've got to back it up. The process is a little more complicated than that, and I have to walk you through. And I'm not really in the business of teaching beginners. I can give you some references that will hopefully bring you up to speed, but you're basically on your own. I can't consult you through to learn what a PIP is and how to size your bank and all that other shit. I don't have time for that because it's me giving the consulting. So I can kind of give you that boost, and when you say, yeah, oh yeah, I think I got it, I'd be ready to take your fast track course, or I'd be ready to take the full trading program course, or whatever it is, then we can talk and discuss whether you're ready to even do that. Oh, I don't want to charge somebody a lot of money to do something they're not capable of doing, or they wouldn't have any interest in doing. So let's have communication and work together as student-teacher and have a good time so that you can make some money and pay your mortgage with your proceeds, or replace your job income. I mean, I don't know what your goals are. So those goals are going to have to be based on some very firm understanding of the life cycle of a currency position. And I want you to be as safe in your trading as you possibly can, and that's why I'm suggesting that we do day trading, okay? Okay, I think I've covered all that. Way too long of a video. If you stayed here this long, hey, let me know that you said, put in a comment, I stayed through the video. And I love you for doing that. Peter Rose, Longwood Currency Trading. Have a great day, and have a great trading day.